Hi, I'm Eric Michael, and this is my oral presentation for Management 5303's Ready-to-Eat cereal case. The ready-to-eat cereal industry profitability in the past can be basically explained by the industry being highly concentrated, stable, and profitable, dominated by primarily three large players: Kellogg, General Mills, and Philip Morris. Philip Morris is the owner of the Post brand of cereal. Through the 1950s, starting in the 1950s through the 1980s, the Big Three controlled 80 to 85% of market share, with returns on assets in the 15 to 30% range, which is very high relative to other industries. Annual volume growth between 1950 and 1993 averaged right at about 3% per year. In 1993, about almost 3 billion pounds of cereal were sold in the U.S., with sales in excess of about $8 billion. Despite being a highly profitable industry, historically there have been a lack of significant new entrants because of restrained competition, some would say collusion between the industry main players, as well as significant entry barriers in the industry. In terms of restrained competition, or the avoidance of head-to-head rivalry, the industry players did this very well in a number of ways. They limited impact premiums, or toys or prizes that could be found inside cereal boxes, to one brand at a time, so that they weren't directly competing with each other at the same time. They also refrained from trade dealing or retailer discounts. In general, they limited vitamin fortification because they believed that strategy long term could increase one's competitive position, and they didn't want to compete highly against each other at the same time. Another thing they did well is they followed orderly and systematic price increases, usually followed by Kellogg. So Kellogg would start off with a price increase, and then the other industry players, such as General Mills and Philip Morris, would reply in kind. In terms of entry barriers, there were several, largest being economies of scale. 75 million pounds per year was the minimum efficient scale for a cereal plant. Huge advertising campaigns, so about 800 million was the total advertising spent in 1993. They also encouraged shelf space plans for retailers based on historical sales volumes, so that the highest sales volume players received the best shelf space, and new entrants had to pay the retailers a premium of about 10% just in order to get that shelf space. Another thing that they did is they had high proliferation of new brands, so they filled every profitable niche in the cereal industry, and thereby reduced retailer and consumer buying power. And also, by doing that, reduce the chance that a new entrant could find a profitable niche that hadn't already been filled by one of the big three players. Starting in the early 90s, and we can see in 1993 some threatening trends for the cereal industry. Number one, slowing growth. In 1993, growth was about 2%. They're seeing a surge in private label volume market share. Right now in 1993, it's at about 9%, which is a significant portion of the market. They're seeing huge growth of non-supermarket food chain sales through supercenters such as Walmart. And this is important because it mitigates the shelf space entry barrier that we talked about earlier, and made it easier for new entrants to find markets. Something else that's threatening is the price promotion spiral that's becoming increasingly harming for cereal profitability. and it's also decreasing consumer willingness to pay because of the higher prices. Something else we're seeing are new entrants in the private label market, such as Malt-O-Meal, Grist-Mill, McKee Baking. We're also seeing brand loyalty eroding due to heavy use of coupons, which encourages price-sensitive brand switching and failed product extensions. In terms of the private label and branded cost structure comparison, we can see that the private label enjoys a significant cost advantage over the big three in terms of their cost structure. The text gives us a retail price, it gives us a retailer margin, it gives us distribution costs, it also gives us manufacturing cost percentages for the private label, and using those numbers we can work backwards and figure out what the different cost elements of the private label cost structure are and as they compare to the big three. When we go through that exercise, we see that although earnings before interest and taxes are lower per pound for the private label, they're actually higher as a percentage of wholesale price. For the big three, the earnings before interest and taxes percentage of wholesale price is about 14%. For private label, the earnings percentage of wholesale price is about 18%. So it's definitely more profitable for the private label manufacturers. In addition, they give higher retailer margin, and they also, private label, give lower consumer costs as well. So there are multiple advantages that the private label has built in terms of the cost structure. What is the General Mills benefit from reducing promotional expenses and prices? Well, if we do some backing out with the math that was given to us in the case, we see that General Mills has about 24% market share, and we have a total industry volume of about 3 million pounds. 3,000 or 2.8 billion pounds. We can use those numbers to estimate General Mills production at about 685 million pounds. Dividing the trade promotion and coupon reduction of $175 million by that amount yields a corresponding savings of about 26 cents on the pound. Similarly, using the big three industry average wholesale price of $2.82 per pound, the revenue loss from an 11% price reduction on the largest brands for the big three gives us total sales estimated at $85 million. Dividing this amount by General Mills production yields revenue losses of about 12 cents per pound. Thus, the net effect of General Mills trade promotion and price reductions is expected to be an increase in profitability of 13 cents per pound. General Mills clearly benefits the most when other industry competitors decide to follow suit and also decrease promotional expenses and prices. If industry average wholesale prices decline slower than the associated promotional expense levels, then General Mills can further reduce promotional expenses without fear of losing market share. Alternatively, if the industry decides to keep promotional spending at current levels, General Mills could find itself at a competitive disadvantage. In this case, game theory provides an excellent tool for gauging the competitor response to General Mills' announcement. The big three are aware that lower prices are necessary to compete with the private label threat, and that price promotion spiral will continue to decrease profitability. The competitors' strategic options are to follow General Mills' example or continue with price increases and high promotional costs. Since the competitors will likely choose the option which maximizes profits, I expect that they will further, as well, reduce promotional spending and prices.